to On the Money with Secure Money. I'm Rebecca Powers, your host this week, here with Brian Quaranta and Neil Major. How has your week been going, guys?
Great, very busy.
I know.
Very good.
Your business is growing. I'm
Yeah,
hearing from the ladies in the office that you have a ton of people coming in. Just asking for advice, education. But I know that once our show airs, you kind of block out some time for our callers.
We do.
To come in and meet with them personally. What kind of things, what are the biggest questions of someone who's never even seen a financial advisor before?
Yeah. Well, the biggest things that we hear are one, are we on the right track?
Yeah.
People really want to know whether or not they're doing the right things. They'll tell us that they're not really sure when to collect their Social Security. They'll tell us that they're going to be retiring or want to retire. They just don't know if they're going to be able to afford to retire. The other big one we hear is that people say we're really concerned about the risks we're taking because we're at a point in our lives where we really can't afford to take another big market loss and lose a lot of money because we just don't have the time to recover.
Yeah.
So those are probably the top questions that we hear quite a bit.
I think it's usually just, are we on the right track?
Yeah.
And am I doing all those other things that you said correct? So a lot of times they don't even know what they should be asking, right?
Yeah.
Because, but to Brian's point, you know, it's like, it used to be when people come in, or when people still come in, if they give you a date of their retirement, you know they have a pension. But that's only about 10% of the people that are coming in anymore.
And pensions used to be very common.
Very common,
But not as much anymore.
Yeah, they've gone away. So it used to be you had a date of when you're going to retire. Now it's, I really don't know, because I don't know how much income I'm going to be able to generate. I don't know how long my money will last. I don't know how taxes will impact my retirement. I don't know when to collect Social Security. I don't know about the safety of my investment. So it goes on and on and on.
Yeah,
it's
so many unknowns.
Yeah, it's a monumental task. I mean, imagine, imagine that, you know, I had to, when I retired, figure out how to build a bridge from one island to another, and I've never built a bridge in my entire life, right? Now, the engineer that's built bridges all of his life, that's easy for him to do. But now I'm going to be tasked with that responsibility, so what am I going to do? I'm going to figure out how to build a bridge by going to Google, and I'm going to say, how do I build a bridge? And
Please don't do that.
And it's going to start talking about all these engineering concepts that are as clear as mud to me, that I don't know. Maybe I'm grasping it a little bit, right? Maybe I'm not, but I'm still very confused. And, you know, it's wonderful that in today's world we have the ability to go out and research things and get information. But a lot of times when people are doing their research online or they're watching YouTube videos, whatever, trying to figure it out, they actually become more confused. And what happens is when they're confused, they get paralyzed and they don't know what to do. And no action is the worst action.
So what do they typically do? They keep working, right?
Yeah, they keep working.
Yeah,
they keep
working.
They just keep working because they're like, we figured we'd never be able to retire. And I think that's probably the most rewarding thing to us, is that when people do come in, you know, we really roll up our sleeves and we do real planning with them right there. I mean, we're crunching numbers with them. We've got a big screen TV that we bring all of this up. They're involved in the planning process so that they understand how we're getting from point A to point B. You know, we're not just taking their information and going behind doors and magically coming back with a solution. We want them to see how that solution is being designed so that they have a good understanding of why it's going to work.
So one of the first things that we do is we identify the income in retirement, the most important thing, right? And so we want to look at net income, right, after taxes, and lay that all out. And we want to get a real good understanding of how much monthly income do they need. Because they'll start to write out, you know, all their expenses, and they'll say, well, I need $2,000 a month. And then what we'll understand and realize is that they take home $7,000 a month right now and don't save any of it.
Right.
So the assumption is they actually need $7,000 a month because that's what they're accustomed to.
Right.
So one of the things that I think that we do really well in our office, and we pull up on the screen, is we show them the preservation rate of their money. So what rate of return, once we identify how much income we need to get you, on the money that you saved, what rate of return do we need to get to keep the same amount, same balance? And what people realize is that they need typically very little return, 2.5%, 3.5%.
I know that's hard for people to believe right
No,
now.
that's great.
I know it's really hard for them to believe.
And I think that's the first time they realize I can actually retire because all I need is 3%.
Right,
Yeah.
and I don't need to roll the dice, but no one's ever broken that down for them before.
I love that.
And I mean, that's such a great point, Neil. You know, and there's really the three rates we figure out. We always figure out the preservation rate because that's important, right? How can you take the money you need and still preserve the principal of your account? That's what we all want to do. But then you also want to know what your spend down interest rate is, meaning, you know, if you're pulling out a certain amount of money, how much can you pull out at a lower interest rate to where maybe the balance of the account would go to zero, but it wouldn't happen until age 100. And then, of course, the legacy rate, which we all want to kind of shoot for, that's when you're pulling money out, but still growing your money at the same time. And those are some good points. And I think the other thing to point out on our cash flow worksheet that we build for the client, you know, if you're a married couple, you may be making this much money together, but we also have to take into account in planning what happens if the spouse dies. Right. Because there will be a loss of income. And according to AARP, the average loss of income to a married couple is about 40%. Wow. So that means you're taking a 40% hit in your income if your spouse dies. Well, what's the plan when the spouse dies? What Neil and I always talk about at the office and our other advisors is we always want to make these bad things happen on paper. Because if we make the bad things happen on paper, we actually have a plan when they do happen.
Absolutely. And if someone, when you mentioned if a spouse dies and you lose that part of the income, do you advise on maybe getting life insurance on partners?
Yeah, when it makes sense, absolutely. I mean, like Brian said.
But that's part of your service.
Yeah, absolutely. So we want to make bad things happen on paper. We want to put volatility into the plan. We want to create loss of income when a spouse passes away. And we want to be able to, why we do that now, instead of dealing with it when your spouse dies, is because now we can create a solution to remedy that issue. And so whether it's life insurance or whatever we have to do to help solve that, it's definitely important. That's why you want to make those bad things happen on paper now.
Exactly.
And in regards to life insurance, a lot of the questions we get about people that have existing life insurance is they'll say, do we need this anymore? Right? Should I get rid of this? Now, a lot of people think that when you get older, that you just don't need your life insurance. Well, before you make that decision,
it's the opposite.
You should really determine how much of a loss of income is your spouse going to have before you get rid of that insurance policy. And, you know, insurance is one of those things that it's, you know, nobody wants to, you know, pay for insurance, but they're all glad that it's there when somebody dies. I've never had to apologize for delivering an insurance check to somebody, you know. I mean, you know, about a month ago, I delivered, you know, a $500,000 insurance check to a client. They were not unhappy about that. Right. So now they've got this sum of money. By the way, it's all tax-free. So
is it?
It's all life insurance is all tax-free. So, you know, if you have a life insurance policy already and you've been paying for it for years, you may want to consider keeping that policy because you know, for you to get a new one later on in life would be very, very expensive.
Because your health is not as good, your age is higher, obviously, so it's more expensive.
But the point I want to address is the fact that, you know, we're not just saying, you know, keep it, get rid of it. We're letting the math tell us what to do. And that's the important thing that people need to understand when they come to Secure Money Advisors is that we keep our opinions out of it. We use technical data to be able to make decisions, and that black and white data lets people make informed decisions. So when we say, is this what, you know, do you want portfolio A or portfolio B? The math is guiding them to where they need to go. It's not some sales pitch.
Right. And you actually have a program that actually shows you and puts the numbers analytically so then you can help them make their decisions.
Yeah, which, by the way, when we come back from this break, I want to talk about that next because that Riskalyze program we use is so powerful. And for the first time, people are really getting a financial x-ray of what's really happening in their accounts and they start to understand it. But before we talk about that on the next segment, I want to talk to you about taking advantage of our complimentary Right Track Retirement Review that is complimentary and no obligation. So for the next 10 callers who call in right now, we're going to sit down with you. It's not very often that you get to sit down with a fiduciary. at no cost and go through your plan. We're going to spend 45 minutes to an hour with you, reviewing where you're currently at, understanding what you have, what your goals are, and where you need to go. Then what we can do is we can take that information and we can do an analysis on it for you, and we can bring you back and we can educate you all on that. That's all complimentary, but you got to do your part. You got to schedule with us today. To do that, call 1-888-382-1298 and schedule your Right Track retirement review.
And when we come back, that's exactly what we'll talk about. Stay with us.
See, everybody can tell you how to invest your money. There's not a lot of people out there and a lot of firms that can teach you how to use your money. Most people also tell you that they're scared. And the reason they're scared is because they're afraid of running out of money.
The last thing you want to do is have a really good job into your 60s, retire, and be looking for work again in your late 70s.
The average person might say, well, a good portfolio would be a good mix of stocks, bonds, and mutual funds. No, 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 no. A good portfolio is all designed around the 5 key areas: income, taxes, investments, healthcare, and legacy planning.
We're not just product pickers here. What we do best here is we build retirement plans.
9 out of 10 people, when they walk through the door, would ask us, we just want to know if we're on the right track. And I always say, if you're not on the right track, when would be a good time to know it? Probably now.
People, can actually see a vision once we start to really build out their plan.
This is about you. If you're not getting what you need, and you feel that when you walk out of the advisor's office, it's time to get a second opinion. And you can't get a second opinion from the person that gave you the first opinion. The difference at Secure Money Advisors, as a fiduciary firm, we help you manage the risk, build the income, and give you the retirement you dreamed of.
All right, welcome back. We were talking about the wonderful Right Track retirement review that you do, guys, and there's something you have that is amazing, the analyzer.
Yeah, Riskalyze.
Riskalyze. I can never get that.
Yeah, so it's a program that we utilize. I think most people that are coming in, or most people that are watching even, they want a second opinion. They might have been with their advisor for a long time, but they truly want a second opinion. They don't want to go into an advisor's office and hear a sales pitch.
Right.
But they'd like to actually get a review of what they're currently doing. And so the software program that we have, the analysis, we look at it as really breakthrough analysis, because it's a true black and white comparison between what you're currently doing and what it potentially could look like. And really the Riskalyze, what it does, one, it breaks down how much risk your portfolio is actually taking.
Wow.
So that's important for people to know. It shows your expense ratio. So what are your funds actually costing you that you're in?
Excuse me, does your husband have to be in the room when they look at what you spend? I'm just thinking. Go on.
Different expense.
Yeah, different expense. But yeah, husband and wife always should be there, right?
Okay, go on.
It takes a look at one very, very important thing that we like to see a lot is what's the max portfolio drawdown? So if bad things happened, how much is my portfolio going to go down? It takes a look at your performance over a 3-year, 5-year time period. So, over the past 12 years, the market's gone straight up.
Yeah.
So every time you opened up your statements, you saw all good things happening. You didn't really know if your advisor was doing fair, good, great.
Right.
You just accepted that you got more money each and every time you opened up those statements. But could there have been a lot more? And was your portfolio actually inefficient? So that's the types of things that Riskalyze does. I think it's a really important tool, getting that true second opinion.
Yeah, I mean, it really does, revitalize what people's expectations are of what they can expect from their portfolio. And when a lot of times in our industry, our industry tends to quantify risk as conservative, moderately aggressive, or aggressive.
Exactly.
But nobody knows what that means.
Right.
Nobody knows what that means. What people want to know is, how much could my portfolio go up? But more importantly, if the market went down, how much can my portfolio lose?
Yeah.
I believe, and I'm sure Neil will agree with me, the biggest data point that Riskalyze gives us is how much the portfolio could go down, how much it could draw down from its high to its low if a market correction were to take place. The analysis that Riskalyze does also will let us run what-if scenarios. So it'll say,
wow.
what if another 2007, 2008 happened? What would happen to your portfolio that you currently have? What happens if we had a financial crisis? What if interest rates continued to go up? So now you can look at your portfolio and you can stress test it under those scenarios, and you can see how it responds. Now what we can do is then we can say, okay, what if we were to just change this position from here to here?
Yeah.
Keep this one, change this one from here to here. What are we seeing now? And typically what we want to find is that if you had this much of a drawdown, so this is how much you could lose when the market goes down, we want to say, well, now with the adjustments, this is how much you could potentially lose, right? So we want to mitigate that downside risk, because in retirement, it really is about mitigating the downside. It's not so much more about how much you earn as it is about how much you keep and the return of your money versus the return on your money. And we want to make sure that if the markets do correct, that you're not taking such a big loss that you can't recover from it.
And then you figure out the exact amount you would need. You protect that amount to get you through retirement.
Yeah, and that leads into what we call our bucketing approach.
Yeah.
You know, and our bucketing approach is very powerful. We have 3 buckets of money that we focus on, and this is really eye-opening to people. This is the simplicity in what we do.
I love that.
Because people can now make a connection of what the purpose of their money is. A lot of times they just see their money as one sum. Okay, and it's diversified among stocks, bonds, mutual funds, but we want to break it out into buckets: bank money, right? What we call safe money or pension money, and then we want risk money, and we help them identify it. A lot of times when we look at portfolios, everybody's got all their money in risk money,
right?
And that goes against what their primary goal is. So when we sit down with people, there's 4 things we go over with them. Right? Tell them a little bit about that, because I think that's important.
So typically, you know, we want our money to do everything, right? We want it to what? And there's really only 4 things your money can do when you invest it. It can provide income, it can provide growth, it can provide safety, and it can provide liquidity, access, and availability of your money. We want it to do all those things. Unfortunately, no investment does all 4 things. And so that's why we break out the buckets. I mean, think about the bank. You know, the bank is available. I mean, it's liquid, it's safe, but we're giving up growth. In the market, the market, if we give it time,
because the interest rate is so tiny in a bank.
Tiny, yes. If we're in the market, if we give it time, we'll see growth.
But you're risking.
You're risking. So we have liquidity, we give up safety, right?
Okay.
We're risking, we give up safety. So that's why we create these buckets, because we want all 4 things done. We just have to create different investments to be able to achieve all 4. Does that make sense?
It does. And when you said stress test, it makes me think, so my health is not just eating right.
Right.
Is not just exercising, is not just taking care of myself, sleeping enough. It's these 3 or 4 things in combination.
That's right.
You know, when we meet with people and they'll tell us, what do we hear the most important things to people are? Income and safety.
Yeah, of course.
And then when we look at their portfolio, all their money is in the red bucket at market risk.
Yeah.
So it's very eye-opening.
It's very eye-opening. When you draw out the buckets for somebody and then you actually put the amount of money that they have in each bucket and they see that all of their money is over here in this risk bucket, the first thing I'll say is, when you look at this, is there anything that jumps out to you immediately? And they're like, wow, we have all of our money in that bucket. You do. Can you afford to have all of this money at risk at this point in your life? Most people are going to tell you no. And that is the right answer, because as you get older, you just don't need to roll the dice anymore and gamble with 30, 40 years worth of work. I truly believe that when you've won the game, folks, you don't have to continue to play it. Once you've saved enough money, your job is to protect it so that you can get through retirement. And this is why I want you to take advantage of our Right Track Retirement Review, because we're going to help you understand these things, give you more clarity and confidence about what you're doing, and really teach you how to use your money. There's so many people out there that have so many goals and dreams to do things in retirement, but they're scared to use their money because they're afraid that they're going to run out. The strategies and techniques that we use, the risk analysis software we use, the tax softwares, figuring out when to collect Social Security, these are all things that we can help you with. It's Secure Money Advisors, we're a full-service fiduciary planning firm. So take advantage of our Right Track Retirement Review today, but you've got to do your part. You've got to pick up the phone and call us today. Don't procrastinate on this. This is not something that you want to kick the can down the road. Call us today and schedule 1-888-382-1298.
Absolutely, and time is money, as we all know. Stay with us. We'll be right back with more.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Welcome back. You know, I have a question. I've been working with y'all, and I love it for a while now, and I hear the word fiduciary a whole lot. Is it the same thing as a financial planner? I mean, explain the importance of having a real fiduciary.
Yeah, so at the office, all the advisors at the office are fiduciaries. And I think Secure Money Advisors approach one legal definition by law. We have to do what's in the client's best interest, first and foremost, obviously.
Yes.
But really what a fiduciary is about is really building out a retirement plan. Not just picking products, but focusing on the plan and coaching you along the way to make sure the execution is flawless. Mm-hmm. So we focus on income planning, tax planning, investment planning, healthcare planning, and legacy planning. Mm-hmm. And those 5 key areas are really what a fiduciary is to work with you on. And then also you can talk about a little bit about the fees and how fiduciaries get paid.
Yeah, I think it's important to understand that, you know, there's a difference between a commission-based advisor and a fee-based advisor. And we're working with people with their investments, we're fee-based, which is very important because, you know, if we are required by law to do what's in the client's best interest and we make changes during different market conditions, as we always do, because market conditions change, business cycles change, and you just can't have a static portfolio that's set it and forget it.
Right.
That's what most people typically do. And so when things start to go bad, they get cookie cutter phrases like, you know, don't worry about it, hang in there, you're in it for the long haul, things will be okay. Mm-hmm. We actively manage, which means when the markets move, we're going to move, right? If that means the markets get volatile, we want to have ways to protect it. And as a fee-based firm, when we make those changes, it's not we're not transacting any type of commission to the client.
Gotcha.
So they've got just the one fee a year that they pay, and that comes directly out of their portfolio. It really is structured in a way that when the clients do well, we do well. When the clients don't do well, we don't do well. So we have skin in the game with the client versus a broker who, when they make a transaction, just gets paid a commission. So their revenue is not tied to any, you know, performance of that portfolio.
Gotcha.
Their revenue is tied to the transaction. So if the portfolio doesn't do well, they're not losing any revenue because they got paid all their money up front. And that's why the industry really is moving towards that fee-based approach, because it's a more trusting relationship with the client. So the client knows that if you're making a move, you're truly doing it in their best interest.
The motivation is sincere.
The motivation is sincere, yeah. And you want to believe that any financial advisor's motivation is sincere.
Sure.
But, you know, at the end of the day, when you transact business, if you get paid a commission, sometimes there's temptation there, right? And if
Sure.
you're not being paid a commission, you really are doing what's best for the client.
So I think one of the things that we'll hear, I just had this example last week, is, someone came in, they said, well, we don't pay anything to our advisor.
That's what you think, buddy.
Yeah, that's what you think, right?
Yeah.
So what they were doing are they're paying all those upfront load fees. And so whenever their advisor called to make a position change, now they don't know, once they realize what was actually happening, they don't know if it was in their best interest or, because a trip to Italy was coming up.
Right, exactly. That actually happened to my husband and I.
Did it really?
About 20 years ago.
Yep.
This guy said, something, a financial planner. He wasn't a fiduciary, apparently.
Okay.
Well, later we find out he was paid $10,000 up front.
Yep.
He sold us insurance products.
Right, yep.
And once we found out, because a great, great friend of mine ended up becoming a fiduciary, she explained it, and we felt violated, to be honest.
Yeah, right.
Anyway, that's just my personal story.
Yeah, we hear those stories.
You do.
And unfortunately, in every industry, you got, the bad apples, right?
Right.
And you hate to hear it because it gives a black-eyed whole industry. But the good news is that, there's a push towards this better relationship with this fiduciary standard.
Exactly.
And we hope the entire industry goes there. Obviously, there's a lot of politics involved because these big box financial planning places earn a lot from their commissions. But at the end of the day, I think the most important thing to stress really is one of the things that Neil mentioned, and that's really delivering a plan.
Exactly.
Right? The plan is so important. We meet so many people that come in with their POS. By the way, that stands for pile of stuff, right? They come with their pile of stuff, and when we talk a little bit about their plan, I want to know, well, can you show me your cash flow worksheet that's been built? We don't have a cash flow worksheet. Can you show me a withdrawal worksheet that's been built so when you're pulling money out, we can they're anticipating maybe what the account balances. We never have anything like that. What do you have? We have just the statements.
Exactly.
And so when you meet with your advisor, what do you typically go over? Well, he just tells us how the investments performed, and that's it. That's not planning, right? That's not planning. Planning truly is going over the cash flow, understanding how much income you have as a married couple, how much you have income coming in together. If one of you die, how much income you're going to have, where to take the money from. Should I be taking it from my retirement accounts, my non-retirement accounts? If I want to leave money to my kids, how do I do that? And that's all written out in the plan. And this is why we always, for all the listeners that are TV viewers, I should say, because I'm so used to saying listeners
on
because
your
of the radio show, which, by the way, you should try to tune into our radio show, too. That's on 94.5 3WS, and it's also on WDVE. You can find out where the time slot is right on our website. But I want to offer you today, for the next 10 callers, a Right Track Retirement Review where we're going to help you truly get some clarity and peace of mind around what you're doing. We will go through the 5 key areas that we always do: the income, taxes, investments, healthcare, and legacy planning. But you have to do your part. You've got to take action, and you've got to call us today to schedule. It's about a 45-minute to an hour meeting where we're really going to discuss all of your concerns, what's on your mind, figure out where you are, and do an analysis of where you currently stand, and then we'll give you turn-by-turn directions of how to get to where you need to go. Again, do your part. Schedule today, 1-888-382-1298.
Hope you learned a lot today. Thanks so much for being with us. We'll see you next week.